Okay, so thank you, Marty. I always appreciate the opportunity to moderate one of your panels. I'm going to let the panelists introduce themselves. Maybe we should shut the door.
I'm going to shut the door, yeah.
So this particular session, I think it's a great segue from the last session because they spoke about managers so much in the last session, and they really brought to light how important managers are in the whole in any part of financial the financial industry. It could be from individual investors to large investors to institutional investors, and the key role that managers play in it. My name is Howard Cohen. I'm an advisor with Strategies for Wealth. I'll get into that afterwards. Ellen, you want to give a little background?
I am Ellen Baker, and my background is started in investment banking, public finance, moved on into private clients, happened to focus on ultra high high net worth individuals. I then started my own business about 13 years ago, where I consult family offices and introduce them to alternatives. Alternatives were exciting to me when I worked at larger firms. They wanted you to sell the soup du jour and stocks and bonds and so forth, which are great. But anybody can sell those at all the major bracket firms. I wanted to find these little nuggets that I thought were special, hence our topic on emerging managers. I like the idea of finding something that's a little different, that it's hard to find something like that. So that's what I like to work with.
Hi, I'm John Trammell. I've had a long career in asset management, both on the allocator side of the table and on the hedge fund side of the table. A few weeks ago, I left Symphony Financial Partners, a fund in Japan, because I'm interested in going some different directions. So I'm looking around the world. Yeah. Two quick things that I want to say about the last panel that I think everybody needs to know. Anytime you run anything through any of the ChatGPT or any large language model, it no longer belongs to you. It belongs to the owner of the large language model. So you should be careful if you're running your quarterly letter and there's something in there that you don't want everyone to read. Don't run it through ChatGPT. So I just wanted to make sure that everybody's aware of that. The other thing that is just interesting to know is that the largest of the large language models, which is the ChatGPT model, they're on Formula 4, I think it is right now. Last time it was updated was in October of 2021. So they cannot update them as fast as that we try and use them. There are many, if things are trending, they're usually about 2 or 3 weeks behind in the database, but you can't ask it for anything that's happening today and get anything other than a Google response. So just good things to know about AI. And I guess in emerging managers, I don't think anybody is going to be using it to make decisions outside of maybe those who have the data models like Millennium, who are big enough and have their own data models to actually run artificial intelligence programs on them, on their own data. Sorry, that wasn't about emerging markets.
No, that's
but I
right.
just had to get that off my chest.
So just for a minute or so, as I said, my name is Howard Cohen. I work with, I'm an advisor with Strategies for Wealth. We've been around for 90 years. And I primarily work with business owners and businesses on their exit strategy, their business continuity planning, exit strategies for high net worth individuals, and making sure that as much money stays in their pockets as possible. So dynasty planning and making sure that your company is registered in the right state is crucial to making sure that not just this generation, but the next generation and the generation after is going to reap the benefits of your hard work. Or also, if you are charitably inclined, make sure that the institutions that you want to support are going to continue to get that support. So let's start with Ellen. We've had a lot of conversations over the years, but how would you define emerging managers?
We talked about this a little bit yesterday, and my thought on emerging managers actually is someone who is doing something a little bit different that's out of the ordinary, not just a hedge fund, but or a VC fund, but somebody that has just explored a way to put together a portfolio of investments that is a little bit different and exciting, and looks to me like it's a new wave.
So would you put a cap on the amount of assets they're managing, or that doesn't make a difference?
I don't see that makes a difference. I think it just depends on what the manager's MO is and how they can perform.
John?
You know, I also think it's the size of the allocator. And many emerging managers basically are friends and family startups, and then they build a name for themselves and that niche that somehow gets out there. But if you're in Austin and you're talking to Texas teachers, their definition of emerging manager is someplace between $3 and $5 billion in assets under management, because they can't allocate less than 200 million or 300 million at a pop. So they literally have a methodology where they're searching for managers who just go over that 3 billion or who are, 2 billion in something and doing pretty well. And they're looking for those managers to bring into their emerging managers program. Now, quietly, they also have a much more diversified emerging managers program. It's interesting because it'll hand out $5 to $10 million contracts to diverse managers. The problem is many of the diverse managers don't want to be put in that category because they want a shot at a larger allocation. So it's an interesting conundrum about how some of the large institutions define emerging managers. But I like Ellen's bit is that either somebody legacy coming out of a group that you know well, but we talk about the Tiger Cubs, Grand Cubs, and there are a number of other firms that have well-trained people and with their backing have started out as managers, and that's usually an interesting place to look for emerging managers as well.
So lift outs.
Yeah, well, not necessarily lift out. Some people leave on an angry foot. They didn't get the bonus that they wanted or something else, and so they've got kind of an anger. Sometimes that's an interesting person to talk to because they've got something they want to prove. Many times they leave the firm with a full blessing of the founder. It's kind of what the founder feels like they're supposed to be doing. You
Sure.
train there, you work there for 10 years, then you can have your own fund.
Stevie Cohen's a great example of somebody who invested people lift out. Yep.
So I mean, it's there are many different ways to get there. And I just think you just have to have a methodology. There's lots of literature out there that you can read that is constantly introducing emerging managers. It's not an easy thing to keep up with.
It's a
So,
hard space.
so the way you described it, I immediately thought of NFL coaches. Those that they talk about the tree of Bill Belichick.
Exactly.
Not necessarily that they come out of it and they're successful, but they came out of that tree, and people want to hire coaches that are the same way. And I guess
The coaching ranks come from the winners.
right,
I think the same thing happens in hedge funds. It's our experience.
right. So do you see particular sectors that there's more influence from the emerging managers than in other sectors? And John, as we're talking, I would love for you to blend in your experience with Japan.
I'll get there. The question you just asked really interests me because I'm a student of the markets. Many of us are, I know, but I'm a student as much of the markets as I am of the structure of the markets. Like what's changed since interest rates went up 5%? What sectors are active in? And you kind of have to have a data tool that will let you take out sort of the top 7 or 10 names out of the market. because the structure of the market completely changes if you take out the Magnificent Seven or whatever. But you can begin to see the changes happening underneath. And I think you need that kind of information to guide portfolio construction and where you're looking for emerging managers. For example, a distressed manager could be an emerging manager, all because we haven't had any distressed for so long that no one knows what they're looking for. And even if there is anybody left out there that knows how to manage a distressed book, I'm sure there are lots of private credit people are trying to train up for it, but
We do.
but looking at the changes in the structure of the market, including, I think somebody in one of the panels was talking about how much cash had been pulled out of hedge funds.
Just keep looking to your left.
I think if you pull China out of that, all the money that came flying out of China is a huge amount of hedge fund money and private equity money that is got pulled out of China that is looking for a home. And because you can get close, if you run a good corporate book, you can get close to 6% with low risk on your cash. I don't think it stops allocation of portfolio construction, but it sure as hell slows it down, right? Because when you can get 4.5% to 6% on cash, it just slows your decision-making down because that risk is a little more tasty than it was when you weren't getting paid anything on your cash.
Ellen?
I don't deal with institutions, I deal with family offices, and so it's a much smaller investment opportunity. And as I was saying before, there are more little nuggets. I have worked a lot with venture capital. I love venture capital. So much fun every time we come, we get together here, we hear of these wonderful opportunities, be it in biotech or whatever. But in general, if you're looking at a VC fund, you'll find one or two might be the 15X and the rest of them, not so much. Of late, I've been very interested in the pre-IPO funds, sort of C-level to IPO, the unicorns. And I've found that this is an interesting area that I've been focusing on. And I know that there's several other people that have come to me, asked me to help them with this. And there's been a lot of interest. So that's sort of what I would consider an emerging manager where I've seen a lot of interest of late.
Are there any particular industries that you've seen these family offices trending towards that come to mind?
Every family office is different. And I find that I couldn't say as a whole, everybody's trending one way or the other. There's some that like biotech and maybe it's for a passionate reason. There was a child that had cancer or something like that, or other people are really interested in tech. So it varies.
What about cannabis? That was in favor for so long and now
You know,
it's,
I knew a lot of people that found it interesting, but also were hesitant because of the legalities and state issues.
There was some fantastic money made in cannabis from lending funds.
Mhm,
As a matter of fact, Chicago Atlantic, which is presented to our group a dozen times,
mhm.
they not only did, they raised hundreds of millions of dollars on their debt fund, but they had a SPAC and they had another debt offering, which I believe was more than $1 billion. So they really, used a lot of financial engineering or were able to reap some benefits
Right.
from it. So and there was actually a hedge fund guys out of Greenwich, Connecticut who did another SPAC. I think they did this back in Canada though, on cannabis. So
John, so on the,
Ellen mentioned venture capital, and I will say that, full disclosure, I went to college in Japan. I've helped to write 2 books on Japan. I've been going back and forth since I was 17 years old. I didn't believe it. It had sort of been beaten into me about 6 years ago, but Japan is really going to be a surprise across the next 10 to 15 years for everybody, not just market-wise, geopolitically. For 75 years, the Japanese basically kept their mouths shut and their heads down. And they were told as a society that the only way that they could redeem themselves was by saving money. And so they became the best savers in the world. Well, the entire society is making a switch. And if you don't remember anything else I say about Japan today, the only thing you have to remember is that they are moving from savings to learning how to invest. Because the government and the society, all the institutions are telling them that the only way, they've made it existential, that the only way that you are going to survive is to take this enormous pile of cash, which is probably around $30 trillion in cash in Japan today. And they are going to learn how to invest it. They don't, if you mention mergers and arbitrage to a Japanese corporation, they say, well, we'll have to study it because they don't know how. Because why would you ever take responsibility for somebody else's employees? So that's changing. Yeah.
What percentage of that money do you think would be going international versus domestic?
That's why the yen is so weak right now, because the NISA accounts that just got opened that are very much like IRA accounts here, they just raised the limit by about 3 or 4 times. And they're not spending the money on Japanese equities. They're buying US bonds and buying US equities. The brokerage houses.
Institutional or the retail, or both?
Most of it's retail. Retail is, so there's about 6 trillion of cash on corporate balance sheets, public corporate balance sheets that you can see in Japan, about 6 trillion. So that other $24 trillion is literally cash, often in shoeboxes in people's homes because it costs you money to put it in the bank. There's no crime. You don't have to worry about anybody breaking into your house and stealing it. So it's a huge number and it's in cash.
You mentioned the maximums that they raised by 3 or 4 times. What is that roughly?
I
US
think
dollars?
they went to, I think it's either 200,000 yen or something like that. It's not a huge number, but when you multiply it, it's a big number.
Yes.
So the reason, and now I'll stop here, Howard.
No, keep going.
The reason that it's going into US equities is that it is impossible to buy 1 share of Apple in Japan. So if you want to buy a unit, and everything's done in units, if you want to buy 1 unit of Sony, it will cost you right now about $38,000. And the average salary is $68,000. So no one's going to buy a 1 unit of Sony because it's too expensive. So that needs to change. And I think Yamaji at the Tokyo Stock Exchange will make it change, but they have to do things slowly. So anyway, the whole reason that tirade on Japan started is because one of the areas that I think will be a great surprise, and you mentioned about liking VC, is that there was last year, I think, $400 million of VC money in Japan. I bet you by the end of this year, it's $4 billion. And I think that growth rate will sustain itself for quite a long time because there's no lack of entrepreneurialism in Japan. It's just that risk of failure is thought about differently there. Like if you go in and do an interview and you say, hey, I tried to start this company and it's on your resume, I started this company, but it's failed. First thing people do is focus on that on your resume. In Japan, they'd say, why would you ever try such a stupid thing and fail? Your parents must be embarrassed. That attitude is changing. And I think venture capital is going to be really big in Japan. And family offices in Japan will be the first ones to finance it. They already are.
So John, I got a question for John. John, you said that Japan is going to surprise all of us in the next 10 to 15, you said. Am I correct?
Yeah.
Those people who saved all that money, they might not be alive in 15 years. So is that what you are building on?
It's a great question, Camille. Do you know of many books that I've read on demography that are all basically, there won't be any of us left in 10 years, were written like in the 1920s and 30s, and none of those long-range things came to be true. So I don't know what sparks a baby boom in a country. I think it's confidence, but I'm not sure that Japan's going to run out of people at the rate.
No, that's not what I meant. I meant, are you betting on the heirs of that wealth? That they will change course?
Yeah.
Is that what you're betting on?
Already in motion. It takes time. Japan, it's not unusual for the chairman of a company to be 80 to 90 years old. Not at all unusual. And so what you're doing is when you're having the age rollover, you're rolling over to people who are in their 60s, maybe 70s, right? And this attitude change is coming from well below that. So I just think that there's going to be huge waves of merger and arbitrage because now they have figured out a way to merge corporate cultures that wasn't there before. And I think the leadership is going to keep moving into younger groups. And it's, like I said, it's gonna be a big surprise.
Go ahead.
I've noticed in negotiating with large Japanese companies, you have two tiers. You have old guys and you have young guys. With old guys, you need protocol, Japanese courtesy and protocol, very regimented. Young guys, not so much. Is that what you're talking about?
Well, there are two, you're right. There are definitely, they're not so much younger and older. They're usually set up in factions. There are people who want to get things done and there are people who love the status quo. And those are the groups you sort of have to figure out. In my experience, it helps a great deal to have a very well-trained Japanese lawyer who graduated from Harvard Law School and went through the bar here. Because the language, the legal language on both sides of that negotiation is a language that you really only learn as a lawyer in both languages. And you really need to know how to speak it to figure out those factions and to figure out how to get a deal long-term done. Now, one other thing you have to realize is that there are 4,600 Japanese publicly listed companies. Only about 300 of them have a market cap of greater than $1 billion. So when you're talking about deals, real sort of cross-border deals like Nippon Steel and US Steel, that kind of thing, there just aren't that many of those deals around. There just aren't that many companies.
So, are there any other questions?
John, what's your last, I don't see you on the list here.
It's Trammell.
Late edition.
I was a late
Oh,
edition.
okay, thanks.
So circling back to the role of emerging managers, it seems to me that this could be a fantastic opportunity, knowing that, knowing what you know about what's coming out of Japan and the potential for coming out of Japan. Do you see that there's going to be a role in the near term for people to take advantage of this?
I think there are a number of people and institutions that already do pretty good work on Japanese funds, whether it's funded funds or individual family offices scattered all over the world. I mean, there are a large number of gaijin investors, both in funds and in the market in Japan. Not so much in emerging managers or venture capital, but I think that'll follow.
And just as a follow-up, how important, you spoke about attorneys, and I've dealt with other countries, but with attorneys knowing the language here and there, same thing with emerging managers, excuse me, about working with Japan. How important would it be for them to know the Japanese culture and Japanese and to know Japanese?
There are a number of Japanese hedge funds which are run by English-speaking people who either grew up or spent significant time in Japan, and their English is better than their Japanese. And so you can often do due diligence on a number of funds because they speak perfect English. It's more difficult if you're talking to, and more expensive, if you're talking to a true Japanese manager whose English was learned probably at school here in the US, but isn't perfect for explaining their strategy.
You find that these managers invest exclusively in Japan, or?
Good question. No. I would add that right now, some of the best Japanese sort of long, short equity managers that are still very much emerging managers are investing in Chinese equities because they think Americans have just blown them out so badly, and that there's still opportunities, not in the big tech companies because they're too much in a political maelstrom, but that there are dozens and dozens of companies in China that have sort of been washed out by all the Western money coming out of China that they still feel make very good.
So the previous panel also touched slightly on AI and just your takes on how AI is playing a role with the emerging managers.
Well, to Suzanne's point, I do think it can be dangerous. And how do you research that somebody's used data? I guess they have to admit that this is one of the sources that they use for their research or investments or whatever. I like to, as you said, you can't understand it, keep walking. It's the emperor's new clothes. I like to know what it is. I like to know it's real. I've not been a Bitcoin kind of person or things that invest in something that doesn't really exist. I like to know that there's a real company, which is why I've recently gone from VCs to, wouldn't it be fun to do investments in pre-IPO? I mean, historically, you know, VCs have done well if you find the right one and it's got the right little nugget embedded in it. But if you find a seed of IPO fund, I mean, this one that I'm working on right now is they've done $500 million already on their fourth fund. And their history has been over the past 9 years, over 2.3x. So it's, ooh, this is something I can shout from the rooftops and be very proud of. It's emerging because it's different. But to me, it's a little bit risk averse. So.
I was at a conference a few weeks ago that I like because it's a bunch of operating people for both investors and hedge funds and large mutual fund firms. And it's all sort of down in the trenches. And I'd love to go to hear what they have to say because it's from a completely different point of view. A year ago, and that conference was just like 2 weeks ago. A year ago at that conference, no one used the words AI, not one time anywhere in the entire conference. Of course, this year, that's all anybody could talk about. The largest users of it so far within the financial industry are the people who are either writing or responding to RFPs, which makes perfect sense, right? So it has not gotten anyone fired or even a threat of fired. As a matter of fact, it's gotten more people hired at higher salaries than they ever intended to pay to become director of AI, or they can't find, they're waiting for kids to graduate because the highest paid job in AI today is a prompt engineer who actually knows how to ask the question, right, to get the right kind of answer. And there aren't enough of them. They're literally waiting for this year's graduating class in data science to come out because that's where they're going to look for prompt engineers.
And they pay a lot of money.
So I don't think AI is going to truly change the investing world for quite some time to come, because I think it's going to take a long time for people to learn how to use it and not have it be dangerous to them.
Yes, in the back.
Just following up on John on one last point about Japan. I can understand your bullishness given the cash levels in retail and institutional. One thing in the back of my mind I'm just curious about your comment about is the macro. Population growth or lack thereof, immigration or lack thereof. How do those drivers fit into your thinking?
Immigration is going to come on strong. It's going to be fought in Japan and the back alleys, and there's a whole lot of don't mess with our bloodlines kind of. I mean, anywhere that there's mass immigration, you get this kind of backlash. It's going to happen in Japan too, but immigration is already going up a lot. I mean, it's just huge numbers. They don't advertise it because they don't want you to come. They want to select who gets to come. So, but I think immigration is going to be a huge driver of it. Any convenience store that you go to, a 7-Eleven or any, there's no Japanese people working there.
When you go to hospitals as well,
Exactly.
the doctors, the nurses,
It helps speak Tagalog.
and all the respect to our friendship. There is crime in Japan.
Oh, of course.
Good. So I just want to say that clear. Emerging managers, they are not one color fits all. They come with different experience. They come from different umbrella companies. And since COVID, emerging managers, they've been hit hard, especially on raising capital and on maintaining teams. Because, you know, when an emerging manager go on his own or on her own, they make promises to their team, to their analysts, to their supporting team, until they get out of the red into the black. they haven't been able to raise enough capital to grow. So it has been very hard for them, except for those that can afford to write certain larger checks, not everyone. And then for the question about family office, again, the family office did not come in one color.
Correct.
Are we in a family, multifamily, or a single family? And for those single families, again, they are not the same color. Because AUM is a detriment for what sector you would invest in. Reference again to the previous panel and to the star of the panel sitting in front of me. She said, when I was 12, I was
The
gonna
checks
tell
in
her,
the mail.
I was gonna tell her, I'll wait for you 6 more years. Suzanne. Just 6. So,
Promise is promise.
This is getting interesting.
Do you guys, you know, a lot of
Marty, you
emerging,
missed the show.
a lot of emerging managers don't have intestinal fortitude. That's what I found.
True.
A lot of guys are like, I always want to be my own manager, blah, blah, blah. And then 5 years into it, they could be managing $500 million and they say, I want to go back and work for a company I don't like.
Same thing with NFL coaches that become head coaches, and they said it's much easier to be a defensive coordinator.
Or they go back and become a college coaches, right?
I think for emerging managers too, I mean, it's different. Running money and running a business are two different
Thank you.
skills.
Yeah.
Right? And they don't necessarily translate, right? When you have a really talented trader that's coming out of a prop desk, it's less relevant today because there's not really prop desk anymore, but back in the day, right? If you raised your hand on the prop desk and you were the star trader and you needed a pencil, somebody put a pencil in your hand.
Yep.
Now all of a sudden you're going to Staples and buying the pencils, right? And you know, there's the whole concept of running money versus running a business. And I think smart emerging managers who have the ability, you know, they bring in a good business person, a chief operating officer, somebody who can fill that role and run the business and leave them to the business of running money. Because I think a lot of guys get tripped up trying to do both. And generally, and again, I'm making a broad generalization, Camille, not like no crime in Japan, no, you know, but generally,
John.
no, I understand what you call them out, but generally, guys who are really good at running money aren't good at running people. And the smartest thing you can see is then bringing in someone to help them manage the team. Because for whatever reason, I don't know why, but those skill sets, and there's exceptions to every rule, but those skill sets tend not to go along with one another. And so generally, when I see a new manager or somebody spinning out, I want to see that they've brought in somebody to help them run the business so that they can focus on running the money.
A lack of emotion is an important skill set to have when you're running money.
Not when you're running people, right? Exactly.
But to your point, though, during the pandemic, it was very difficult for lots of people to raise money for their funds because there's big numbers involved. And you know, what happens in Zoom calls is, here are my notes, this is what I'm gonna cover in 45 minutes, boom. And you don't really get a sense of, I think I'm gonna, you know, jump over the fence and give them $500,000. So I think there was a lot of money waiting till they could actually kick the tires in person.
And then they will reconsider the emerging manager.
Well, whatever, but it's not just the emerging managers. I think a lot of people with newer funds, whatever they may be, found that it was difficult to close business just on Zoom.
I think during the pandemic, a lot of dollars went to existing GP relationships.
Yeah.
And
Because
big firm.
and big
Big
firms,
firms.
because they knew you know, you had a comfort level, you knew they had the staying power, there was already a relationship there. I think large institutions to a certain extent wanted to consolidate their GP relationships because just from a management perspective. So I think it was really, really hard for new people to raise money. But you know, look, these things often swing, the pendulum swings too far one way and then it's, you know, it'll
I think
mobilize.
that's why it's a good time to explore emerging management.
Do you think regulatory environment is impacting anybody? I mean, I've heard a lot of people say, actually,
It's harder to start a
somebody
fund.
was talking about launching a fund. And I was talking to a guy who was a lifelong third-party marketer, broker dealer, and he said, I would not start a fund less than, you know, $200 million at all if you know, it has to be, it just has to have scale. Because it's a very difficult regulatory environment right now.
The regulatory environment picks on the smaller firms. It's just the way it is.
Well, and I think, look, post Madoff, right, the world changed, right? Operational due diligence didn't exist pre-Madoff, right? I mean, I remember my dad, when he was alive, only invested in alternative managers and, he through friends, whatever. And after I said, Dad, you can't invest with anyone unless I know somebody who's done the ODD, right?
Right.
And so that's one piece of it. Then you've got the regulatory environment. I mean, the era of two guys coming out of college and starting in a dorm room or a garage with, a computer, a Bloomberg terminal, and the golden retriever at the feet is over, right? I mean, you can't do it anymore. You can't go, when I first started in this business, you'd go to Europe to go raise money. You'd go to London, you'd go to Geneva, you'd go to Zurich. Now you have to have a license in all those places to be able to call on people. So how can you do that if you're just starting out? It's next to near impossible. Like, as I said, when I started, cold called people, set up a road show, and you went.
As I
Now
said,
it's totally
difficult for these newer, smaller groups. The big people have, bigger companies have put the regs, put the pedal to the metal in that smaller firm.
I'm sorry, we're out of questions. We'll talk about it on dinner. Thanks so much, guys. Great job.
Yeah.